Welcome back. Your quiz this week, as well as your homework assignment, has a couple problems that deal with partnership formation, partnership distributions, and partnership taxation. Let's get started with some practice problems to illustrate each of these concepts. If you're a fan of The Office, you know that in around season 5, 3 of the characters spun off and created their own paper company. To illustrate these partnership concepts, we're going to assume that their company was a partnership. Michael and Pam are general partners who do the work selling paper, and Ryan is a limited partner. The partnership agreement provides that Michael and Pam are each allocated 40% of profit or loss, and Ryan, the limited partner, is allocated the remaining 20%. The company pays a $3,000 monthly guaranteed payment to Michael and an $1,100 guaranteed payment to Pam, which makes sense since they're doing the work. The company was founded in 2009. So let's look at this from the beginning. In 2009, Michael and Pam, the initial partners, contribute the following assets to the partnership. In the beginning, they each take a 50-50 stake in the partnership. Michael contributes his company car, accounts receivable, and inventory, all likely stolen from Dunder Mifflin, Scranton, and Pam Beasley provides cash, valued at $200,000. Pam's the easy partner to figure. Her cash and her basis and the value to Michael Scott Paper Company are all across the board $200,000. But for Michael, it's a little bit trickier. Let's look at those nuances. So first, what is Michael's realized and recognized gains? The realized gain is what he should be taking, except, just like corporations, partnerships defer the gains and losses until the partnership does something with the assets. So we're assuming that Michael's partnership share is valued at $200,000. The value of his contributed property is $75,000, and that's the sum of his $50,000 basis in the car, the zero basis in receivables, because they're worth nothing until you collect on them for tax purposes, and the $25,000 basis in inventory. The difference between those two numbers is $125,000. Now, because Michael contributed inventory and receivables, these are ordinary income items. He won't capture that gain as a capital gain or loss, but he will capture them in the form of income when the partnership sells the assets and collects the receivables. His recognized gain is zero because under Section 721, the partner and the partnership transfer assets and receive assets, respectively, without tax consequences. And as we said, since Michael contributed ordinary income producing property, this will be ordinary income that gets passed through to him in accordance with the partnership agreement. So what's the partnership's basis in Michael Scott's transferred property? The partnership takes a carryover basis in the assets. This means whatever the basis was to Michael Scott is now the basis to the Michael Scott Paper Company. And remember, you can inside basis always equals outside basis. What the partner contributes to the partnership is equal to what's inside the partnership, and the partnership can do work with. The car is worth 50 grand to both parties. The receivables are worth zero to both parties, and the inventory is worth $25,000 to both parties, for a grand total of $75,000. So what's Michael's basis in his partnership interest? Remember, the partner himself takes a substituted basis in the property. Whatever the value of the assets to the partnership is the value on the books of Michael's basis in the partnership. The outside basis of the partner has to be equal to the inside basis of the partnership. So again, we see the same classification of assets and their inside and outside bases. Michael's outside basis in his partnership interest is $75,000. And in a couple slides, we'll take a look at how that would have come back to him when we examine the effect of partnership operations on the partner himself or herself. So let's say within 30 days of the formation, Scott Paper collects the receivables and sells the inventory at fair market value. How much income would Scott Paper recognize? The inventory carries a fair market value of 60 grand. The receivables carry a fair market value of 90 grand. The basis to Scott Paper is $25,000 for the inventory and $0 for the receivables, because for tax purposes, receivables have no value until they're collected, which means that the partnership incurs ordinary income and receivables income of $90,000 and $30,000. The portion of the income that Michael would collect gets allocated back to him at the end of the year. So let's fast forward a couple of years. It's now 2016. There have been some intermediary changes to the partnership basis. They picked up a third partner, Ryan Howard, who contributed capital but doesn't contribute to the effort of the company. And we're looking at what happens at the end of the tax year, how the money from the partnership gets distributed to the individual partners, and how those distributions impact the partnership basis. So at the end of 2016, we learned that Scott Paper collected $3,300 in interest income from a mutual fund, and that it was a good year for the partnership. They're able to distribute a total of $20,000 cash to its partners, with Pam and Michael each receiving $8,000 and Ryan receiving $4,000. So let's look at the taxable effect of this transaction. So let's take a look of the individual partners' consequences for the partnership's activities. We know that Michael and Pam each take guaranteed payments, which are effectively their salaries for doing work on behalf of the partnership. Michael receives $3,000 per month, Pam $1,100 per month, and Ryan, as a silent partner, receives zeros. The partners agreed to split the ordinary income and the all income, actually, in a 40-40-20 pattern. So Michael receives $36,320, Pam receives the same, and Ryan receives half of that. And this is the ordinary income that the partnership earns during fiscal year 2016. They also reported a gain of $3,300 for their investment income, and that gets split in a 40-40-20. Michael and Pam, as the sole proprietors doing the work, have to report this amount as net earnings from self-employment. They would compute this on their 1040 form using the Schedule SE. Ryan, as a limited partner, does not have to do this. It's considered partnership income and treated accordingly. Each also receives a cash distribution. These are considered a withdrawal of their original deposit to the partnership and is not a taxable transaction. So let's look at how the partnership activity impacts the individual partner's basis. When the partner is allocated a share of partnership income, which we saw got split between the three partners in a 40-40-20 method, but they don't take that as a distribution, it builds up the partnership investment. Inside basis has to equal outside basis. So this increases each partner's basis. The cash distributions are considered a non-taxable return of investment, and they are considered a deduction from basis. So now let's see how this impacts the three partners. As we see, a lot of stuff has happened since the 2009 formation. Michael has a basis of 35,000, Pam has a basis of 60,000, and Ryan has a basis of 100,000. We see the same increases that we saw on the Schedule K1 and the same decrease from the cash distribution. We add the increases for income, we decrease the distributions to arrive at the adjusted basis at the end of fiscal year 2016, as demonstrated. There are other transactions that adjust the basis, and we would have read them in the chapter. So now let's look at what happens down the road if there's a loss. It's 2018. It's been a rough year for small businesses. Pam and Michael forgo their guaranteed payments to keep the company afloat. Totally generous of them. But the paper company still generated an operating loss of $160,000. The paper company did still receive the $3,000 interest income from the mutual fund. What happens to the partner income? As we saw, each of the partners went with their guaranteed payments. They each take the losses in the appropriate share, and they each share the interest income in the agreed upon ratios. Michael and Pam suffer a loss, each of $64,000, and the company is not able to make a cash distribution for the current year. But remember, because a partner can't go any lower than their basis in the company, the share of the loss is limited to each partner's adjusted basis in the partnership interest immediately before making the adjustment for the loss. So let's see the impact that the loss transaction has on the three partners. We know that some activity has happened between 2016 and 2018. Michael has a basis of 18,000, Pam 43,000, and Ryan 91,000. Obviously 2017 was a crappy year too. They each record the interest income of $1,200 and $600 respectively. This means that Michael's loss is limited to the sum of his basis and the interest income. Pam's loss is limited to the sum of the basis and the interest income. And Ryan has enough basis to cover the whole transaction. So he takes a loss of 32 grand. Michael now has an adjusted basis in the company of 0. Pam now has an adjusted basis in the company of 0. And Ryan now has an adjusted basis in the partnership of 0, $60,140. The remainder of that is a loss that's non-deductible that gets carried forward. Hopefully 2019 will bring good things to the Scott Paper Company. Otherwise, they'll have to consider liquidation, which we didn't cover in our class lecture or in our homework problems, but you would have read it and understood the gist of it. Happy homeworking. If you have any questions, feel free to email me or message me on Moodle. I'm here to help you. Thanks.